Not long ago, experimental hardware projects were one of the clearest symbols of ambition in the US tech industry. Futuristic prototypes, concept devices, and limited-release gadgets regularly appeared at product launches and developer events. Smart glasses, modular phones, home robots, experimental wearables, and niche consumer electronics were framed as bold bets on the future. Today, that pattern has shifted. Across American tech companies, experimental hardware projects are being scaled back, delayed, or quietly shut down, and the reasons reflect a deeper change in how the industry now thinks about risk and return. The most immediate factor behind this pullback is cost structure. Hardware experimentation is capital-intensive in ways software is not. Designing physical products requires upfront investment in components, tooling, manufacturing partners, certification, logistics, and after-sales support. Even small experimental runs can require millions of dollars before a single unit reaches a customer. As US tech firms face higher operating costs across the board, experimental hardware has become harder to justify financially. Supply chain realities have also reshaped decision-making. While global supply chains have stabilized compared to earlier disruptions, they remain fragile. Component shortages, geopolitical risk, transportation costs, and supplier concentration all add uncertainty. Experimental hardware projects lack the scale and leverage of core product lines, making them more vulnerable to delays and cost overruns. For leadership teams focused on predictability, that uncertainty is a major red flag. Another key issue is slower consumer adoption. American consumers are keeping their devices longer than ever. Smartphones, laptops, and wearables now deliver more than enough performance for everyday needs, reducing the urgency to adopt entirely new hardware categories. Experimental devices often require users to change habits or learn new behaviors, and that kind of behavioral shift has become much harder to achieve. Without strong early adoption, experimental hardware struggles to gain momentum. Investor expectations have changed as well. During periods of aggressive growth, investors tolerated failed experiments as part of innovation culture. Today, boards and shareholders are placing greater emphasis on cash flow, margin stability, and clear paths to profitability. Experimental hardware projects often fail these tests. Long development cycles, uncertain demand, and limited scalability make them less attractive in an environment focused on financial discipline. Internal resource allocation plays a major role in this shift. Engineering talent is one of the most valuable assets in US tech companies. Leaders are increasingly directing that talent toward areas with clearer strategic impact, such as software platforms, AI capabilities, cybersecurity, and infrastructure efficiency. Experimental hardware projects can absorb top engineers for years without guaranteeing meaningful returns, which makes them harder to defend internally. Regulatory pressure has also increased the cost and complexity of hardware launches. Physical devices must comply with growing safety, privacy, environmental, and data protection standards. Certification processes are more rigorous. Documentation requirements are heavier, and legal exposure is higher. For experimental products with uncertain demand, regulatory overhead alone can outweigh potential benefits. Brand risk is another important factor. Consumers have become wary of first-generation hardware products, especially from companies with a history of discontinuing devices. Abandoned platforms, limited support, and short product lifespans have damaged trust. US tech firms are more cautious about launching experimental hardware publicly because failure now carries reputational consequences, not just financial ones. Instead of public experimentation, many companies are moving hardware innovation behind the scenes. Internal prototypes, enterprise pilots, developer kits, and controlled trials allow teams to test ideas without exposing them to mass market risk. Innovation continues, but it is less visible and more tightly managed. This shift reflects a preference for learning quietly rather than failing publicly. Partnerships are increasingly replacing standalone hardware efforts. Rather than designing, manufacturing, and distributing devices alone, US tech companies are collaborating with established hardware manufacturers or licensing technology to third parties. This approach reduces capital risk while still allowing companies to explore new form factors and use cases. The rise of software-based alternatives has further reduced the need for experimental hardware. Many experiences once envisioned as dedicated devices are now delivered through software on existing platforms. AI features, augmented capabilities, and automation tools increasingly live inside smartphones, laptops, and wearables consumers already own. This makes standalone experimental hardware less necessary and harder to justify. AI itself has reshaped hardware priorities. Instead of launching new consumer devices, many US tech firms are focusing on optimizing AI performance within existing hardware ecosystems. This strategy offers broader reach, faster iteration, and lower risk compared to introducing entirely new physical products. Strategically, focus has become more valuable than novelty. Companies are prioritizing ecosystem strength, reliability, and long-term support over ambitious but uncertain experiments. Hardware projects that do not clearly reinforce the core platform or revenue model are increasingly sidelined. This pullback does not mean US tech companies have stopped innovating in hardware. It means innovation is being filtered through stricter economic and strategic criteria. Experimental projects must now demonstrate clearer paths to scale, stronger alignment with existing products, and better cost control from the beginning. Ultimately, the retreat from experimental hardware reflects a broader cultural shift in the US tech industry. Growth at all costs thinking is giving way to sustainability, efficiency, and resilience. In that environment, bold experiments still happen, but only when they fit within a more disciplined view of risk. US tech companies are not abandoning the future. They are redefining how they approach it, choosing fewer bets, demanding stronger justification, and favoring innovation that can endure rather than impress briefly.